In the previous episode, we discussed what it really means to understand a business. That leads to a broader question. Once we enter the market, what is actually worth our attention? Every day, people worry about index movements and trading volume. They debate bull markets, bear markets, and the global economy. Financial media, market commentators, and content creators constantly discuss the latest hot theme. Some people celebrate a 5% gain today. Others suffer over a 3% loss. Together, they create the constant noise and excitement of the capital markets. Yet most of this attention produces very little value. Spending our time on daily price movements is a waste of life, an insult to intelligence, and irresponsible toward our families. In my view, once we enter the stock market, we only need to think clearly about 4 questions. That alone puts us ahead of the game. The first thing to understand is that cash is a form of wealth, but it is one of the worst forms in which to hold long-term wealth. Unless circumstances force us to, we should avoid keeping the wealth we have earned through work in cash for long periods. The reason is simple. Cash itself, whether physical or digital, produces nothing. At the same time, 24 hours a day, 1,440 minutes a day, and 86,400 seconds a day, its purchasing power is being chipped away. Consider the United States. According to the Federal Reserve's M2 series, the money supply was about $4.67 trillion in January 2000. By May 2026, it had grown to about $23.05 trillion, nearly 5 times as large. As long as the modern monetary system continues to operate, this long-term expansion of the money supply will probably remain with us throughout our lives. For anyone holding cash over long periods, the practical problem is that inflation continually erodes purchasing power. Money is primarily a medium of exchange, a bridge that allows us to move from one asset to another. Investment assets can be divided into 3 broad categories. The first is cash and fixed income assets, such as bank deposits, money market funds, and bonds. The second is non-income producing assets, such as gold, art, collectibles, and antiques. The third is productive assets. The first important principle we need to establish is this: converting productive assets back into cash does not automatically make us safer. We should make every reasonable effort to reduce the proportion of long-term wealth held in cash and fixed income assets. Both logic and history show that equities have delivered higher long-term returns than cash and bonds. Equity is the residual claim on a company's assets and earnings after its debts and other senior obligations have been paid. Shareholders rank behind creditors in the capital structure, so equity carries more risk than debt. Equity must offer investors a higher expected return to compensate for that additional risk. Without this risk premium, profit-seeking capital would have no reason to accept the lower priority and greater uncertainty of owning equity. That is why equities have historically produced higher long-term returns than bonds. A large body of rigorous academic research has reached the same conclusion across countries. Between 1900 and 2000, the difference between investing the same amount in equities and bonds was enormous. This was true in Germany, which was defeated in both world wars, and in the United States, whose mainland was largely spared the destruction of war. In Germany, 1 unit invested in equities grew to 10,434.9. The same amount invested in bonds grew to only 14.5. In the United States, equities grew to 18,630, while bonds grew to 103.4. Anyone who wants to understand these results more deeply can read Triumph of the Optimists, 101 Years of Global Investment Returns, written by London Business School professors Elroy Dimson, Paul Marsh, and Mike Stanton, as well as Jeremy Siegel's Stocks for the Long Run and the Future for Investors. Once we understand this, we naturally become more cautious about familiar market sayings such as, "Cash is king," and "You never go broke taking a profit." We can also better understand Warren Buffett's statement, "Our favorite holding period is forever." Give up trying to predict short-term market movements. Focus on long-term returns. The long experience of many great investors points to the same conclusion. Short-term price movements in capital markets are extraordinarily difficult to predict. For centuries, there has been no credible record of anyone becoming enormously wealthy by discovering a secret law of short-term price movements and applying it at ever greater scale. A simple calculation shows how absurd the idea becomes. Suppose someone discovered the secret of short-term price movements. The world's stock, futures, and foreign exchange markets would become that person's personal cash machine. Start with $10,000 and earn only 3% on every trading day. By the 787th trading day, that fortune would reach approximately $126.7 trillion. That would exceed the estimated $126.3 trillion value of global GDP in 2026. It would equal the value of all final goods and services produced across the entire world in 1 year. The result is absurd. The harder someone works at such a fantasy, the more painful the eventual outcome is likely to be. Give up that fantasy and half the battle is already won. If historical price data could be used to generate unlimited profits at scale, this absurd result would become reality. As AI becomes more widely used in financial markets, short-term trading will only get harder. Once we understand this, we should treat the search for reliable short-term trading profits the same way we treat the search for a perpetual motion machine. We should abandon the fantasy of getting rich quickly. The stock market cannot reliably fund tomorrow's living expenses, next year's car, or the down payment on a home. Anyone who needs an immediate payoff will find faster results in a casino or a lottery. The real purpose of the stock market is to solve problems that may be 20 or 30 years away. Imagine that you are 30 years old, start with $40,000, and add another $4,000 from salary, bonuses, or other income at the end of every year. Your wealth would develop as follows under different long-term annual returns. As of late June 2026, Forbes estimated Warren Buffett's net worth at roughly $147 billion. He was 95 years old. Under the assumptions in this table, a 25% long-term annual return would produce approximately $111.5 billion by age 95. That is already within the same order of magnitude as Buffett's fortune. Look at the table. Then look at Buffett's age and wealth. Does it still seem so far out of reach? Perhaps not. Jeff Bezos once recalled asking Buffett why, if the method was so simple, more people did not follow it. Buffett's answer, in essence, was, because this is a way to get rich slowly, and people do not like getting rich slowly. Apart from cash and fixed income assets, there are two other broad categories of assets we can own: productive assets and non-income producing assets. The value of a productive asset is driven by two forces: the income generated by the asset and market sentiment. A non-income producing asset generates no cash flow of its own, so its return depends mainly on what future buyers are willing to pay. Market sentiment is the combined result of countless participants' emotions. Every participant influences that result while also being influenced by it. That creates a feedback loop no one can reliably solve. We can't always tell what our spouse is thinking. We can't always understand what our own children are thinking. There is even less reason to believe we can continuously predict the emotions of millions of strangers. Isaac Newton is often quoted as saying, "I can calculate the motions of the heavenly bodies, but not the madness of men." We can't know how far sentiment will swing, but we can still identify a reference point: the risk-free rate of return. The risk-free rate is usually approximated using the yield on long-term government bonds issued by a politically and financially stable country, such as a 10-year government bond. For simplicity, assume that the 10-year government bond yield is 4%. 4% is 1 divided by 25. In equity valuation terms, a 4% earnings yield is equivalent to a price-to-earnings multiple of 25. If we invest $100 in a government bond yielding 4%, we receive $4 of annual income. When people are optimistic, they become confident about the economy and the future of businesses. They expect corporate profits to grow and become willing to pay more than 25 times current earnings. The buyer may think this way: the business earns only $3 today, but it may earn $5 next year and $7 the year after that. Over time, those growing profits may exceed the bond's fixed annual income of $4. That's why I'm willing to pay $100 or even more for the equity. When people are pessimistic, the opposite happens. Even if a business currently earns $4, a buyer may offer only $50 because they believe the company will fail to earn even $4 in the years ahead. This is how markets work. We can be certain that sentiment will continue to swing between fear and greed. We cannot predict how far either extreme will move away from the reference point. Human fear and greed have changed very little over thousands of years. Market sentiment therefore swings back and forth again and again. Over the long term, the company's ability to generate profits becomes the decisive force behind investment returns. Charlie Munger once explained the idea this way. Over long periods, a stock's return is closely tied to the returns earned by the underlying business. If a company earns a 6% return on equity for 40 years, the investor's annual return after 40 years is unlikely to be very different from 6%, even if the shares were originally purchased at a bargain price. If a company earns an 18% return on equity for 40 years, the eventual return may still be highly satisfactory, even if the investor originally paid a relatively high price. This sounds counterintuitive. It appears to conflict with the familiar claim that the key to investing is buying cheaply. We can test the idea with a simple calculation. Assume that two companies retain all their earnings, maintain constant returns on equity, and are eventually sold at book value. The first company earns a 6% return on equity and is purchased at only 0.5 times book value. The second company earns an 18% return on equity and is purchased at 2 times book value. After 10 years, the low return on equity business purchased cheaply is still ahead. After 20 years, the high return on equity business has overtaken it. After 40 years, the effect of the original valuation has fallen substantially. The annual returns have moved much closer to the returns on equity produced by the two businesses. Munger was right. The calculation is more reliable than intuition. When choosing between the right business and the right price, which deserves more weight? This is one of the most heavily debated questions among value investors. My current view is that the first priority is getting the business right. The second is avoiding an excessively high price. Choosing the wrong business can be fatal. Time can often make up for paying a somewhat high price. We can place businesses into a 9-box matrix according to business quality and valuation. Category 1, a good business at a cheap price, is a money printing machine. Categories 2 and 3 are potential money printing machines. Categories 4, 5, and 6 are subjects for further study. Categories 8 and 9 can be rejected immediately. Category 7 is more controversial. I personally prefer to avoid it. What is a good business? A good business is one that will continue earning more money in the future. Good businesses can be divided into two groups. The first group includes companies that have already been highly profitable and are likely to remain highly profitable. The second group includes companies that have not yet been profitable but may become extremely profitable in the future. Predicting the future is more difficult than observing the past. For that reason, I prefer to search among companies that have already demonstrated an ability to earn substantial profits. This approach means missing the earliest stage of growth in certain businesses. That is fine. We do not need to capture every dollar a company creates from birth to maturity. The first 3 questions address the following choices: stocks or cash, long-term planning or short-term speculation, the growth of good businesses or speculation in bad businesses driven by market sentiment. Together, the answers point toward holding the equity of high-return businesses for long periods. The next question is whether we should concentrate our portfolio in a few good businesses, perhaps even one, or diversify across many businesses. My suggestion is simple. Begin with diversification and gradually move toward concentration. The most complete form of diversification is index investing. Buying a low-cost, broad-market index fund allows us to own hundreds or even thousands of representative companies in a single market. As companies' market values change relative to the rest of the index, their weights change. Companies that grow in value gain weight. Those that decline lose weight and may eventually leave the index. Over the long term, investors can earn a return close to that of the overall market being tracked. That is what it means to begin with diversification. We may improve the result further by buying less when overall valuations are high and more when valuations are low. There are 2 practical ways to do this. One approach is to monitor the valuation of the broad market and establish a rough range. Buy more when valuations are relatively low and less when they are relatively high. The other approach is to invest a fixed amount at fixed intervals. A fixed amount naturally buys fewer shares when prices are high and more shares when prices are low. A fixed schedule reduces the influence of market noise and helps us resist fear and greed. What does it mean to move gradually toward concentration? While investing in index funds, we can continue studying individual businesses. Remember the earlier table showing a 30-year-old investor starting with $40,000. An improvement of 5 percentage points in long-term annual returns can create an extraordinary difference in wealth over several decades. Learning to understand businesses can therefore be highly rewarding. By studying company disclosures and industry research, then cross-checking them against information from customers, suppliers, and competitors, we can gradually build a sound understanding of the company. When we believe we understand the business well enough and the price is appropriate, we can allocate part of the portfolio to owning it directly alongside the index fund. If we make steady progress and understand one additional business each year, the portfolio will naturally become more concentrated over time. That is how we move gradually from diversification toward concentration. What does it mean to understand a business? We discussed this in the previous episode. When we can answer the following 4 questions, we can reasonably say that we understand the company. First, what products or services does the company sell, and where do its profits come from? Second, why do customers buy from this company instead of choosing another supplier? Third, capital naturally seeks profit. If this company earns attractive profits, why have competitors failed to offer better value, take its market share, or force its margins down? Better value can mean offering the same quality or quantity at a lower price. It can also mean offering better quality or more quantity at the same price. Fourth, if a well-funded competitor or a powerful company from another industry entered the market aggressively, could this business defend or even expand its market share? Until we can answer these questions, we should stick with broad market index funds and keep studying. Stocks or cash, long-term planning or short-term thinking, the growth of good businesses or speculation in bad ones, concentration or diversification. These are the major investment questions that are truly worth our attention. Once we stop worrying about everything else, we have already gained an important advantage. After thinking clearly about these 4 questions, the remaining work is simple. Read with pleasure, enjoy life, wait patiently, and grow wealthy slowly, forever.